The last week has been fairly red right across the market, although we're not seeing massive drops across the board. Overall, based on price, we would say sentiment does seem a little bit negative in the shorter term, but more specifically in terms of healthcare, we're seeing companies down considerably. ELV 10%, CI down around 6%, and the likes of UNH, CVS. But the main one is CNC that we have to talk about today, down around 40%. And whilst we see the wider economy focusing on the tariffs, which continue to be a question, what will happen with the countries that aren't in fact coming to the table with the rates that Donald Trump wants, the threats he's doing now on pharma at around 200%, that when we put to one side, we do in fact see that year to date, markets still very strong, highs week on week, well above the Liberation Day lows, companies up double digit, but what we're identifying here is year to date hasn't been the best for the majority in the healthcare. United Health down 40%, we have ELV down around 6%, yes, CVS Health a great performer as we have mentioned before, up nearly 50%, but Centene Corporation down 46% in 2025 isn't really what you want to see as an investor. Couple that with the fact that the market is now starting to move into extreme greed. We have seen a bit of a back forwards greed, extreme fear. So investors are clearly buying stocks. It just so happens to be that they're buying stocks that we deem to be overvalued, trading at very high valuations. Yet the sector that continues to be neglected, we are speaking about this quite a lot. It is because we see some true value, at least in the longer term. UNH 12 forward valuation, we've said this before, well below its 5-year, in fact at the lowest point. The same for pretty much the majority, but what should really be catching your attention, CNC forward valuation just above 4. So we're going to identify two things in the episode. Clearly, we need to understand the updates to why this company is dragging down 51% over the last year. Year to date, down 46% as we've highlighted. And if you've been an investor in this over the longer term, you would be down 13%. Meaning if you invested $10,000 10 years ago, right now you would be sitting at around $8,700. That is not what any investor wants, and that is what we also need to think about moving forwards. And the other thing clearly is, on a valuation perspective, is this one we should be buying? Is at a new 52-week low. We have a double buy from both Seeking Alpha as well as Wall Street, and a quick spoiler alert for the rest of the episode. We have a valuation grading A+, growth at an A, and profitability at an A-, which is quite rare and does set us up perhaps to talk about a great opportunity in the market. Now we have to make you aware, given the very large drop we've seen, now trading in the $33 region, the price of this company hasn't been this low since 2016, so we're talking a near 10-year low, which in itself is incredible. But the other thing we also like to update you on, as we did last week, is on the RSI. Now, quick reminder for those that are perhaps new, RSI stands for the Relative Strength Index. Simple tool, investors see if a stock has been rising fast or in fact falling too fast. Score from 0 to 100. Now we can see here, in terms of this purple tunnel, anything above 70 means it's overbought expensive. We rarely see this, maybe on 2 occasions in the last 10 years. And the opposite is below 30, which we pretty much only see for the first time now. That means oversold, too cheap, and it doesn't predict the future, but it helps spot when a stock might be due for a bounce or a pullback. Right now on updated performance, it is sitting around the 15 mark. Doesn't mean we're going to see perhaps a massive bounce, but very interesting to note, based on this, it does look incredibly oversold. Now, if we just go back a few months, Analyst had in fact put this company at a $61 intrinsic price. And in fact, last month, Morgan Stanley gave this an overweight rating. They believed that this company could in fact outperform the rest of the market. Their own price target was sitting at $70. And then just from a few days ago, again, something we're seeing from many analysts, we didn't want to take up too much time on this, so we'll just say one of them, but Bank of America have in fact lowered their price target, But what you're noticing, even at $52, that is still a very, very large difference to where the company is sitting now, which does indicate a large, in the short term at least, potential upside. We will get to that shortly as well when we get to our valuation. And we also thought it was quite interesting that if we just look over the last few months, members of Congress have actually been buying this company. Granted, it was before the issues that were lying within, but it's something worth noting, and perhaps when they release their next batch of buys, we could see this start to crop up. They could continue to buy. And then we move to the insiders with very low percentage, 0.4%. They've actually been buying over the last year at around 2.7 million. Now, yes, it wasn't in the most recent Q2 or Q1, but we did see in Q4 insiders buying, which we would say typically a bullish signal. However, it's also justified if you do want to put this to one side, given it is a little bit outdated. And then we move to the institutions with their 94% ownership. Yes, they've been selling more over the last year, 6.4 versus 5.8 buys, but actually in the most recent quarter, institutions have been buying more. We see 1.1 billion buys versus 280,000 worth of shares sold. Now, it isn't the full data set, but if this theme is to continue, we could in fact see a company that in 2025 has had members of Congress buying, insider buying at the back end of last year, and institutions adding. Some may say that is worthy to note, others may disregard. Information just purely here for your own thesis. Now, before we talk about why this company is down, if we just look at their business model, ACA Marketplace makes up 20%, which we're going to cover. It is largely the reason for the drop, but they also have Medicare and Medicaid, which makes up 75%, and this is actually also an issue the company is facing, but many also in the industry. And this is because the big, beautiful, juicy bill that Donald Trump has in place is proposing large Medicaid cuts. That's going to reduce the federal funding and shrink the number of people who are eligible for the program. And since the majority of their revenue, as we've highlighted, does come from managing these plans, fewer enrollees will ultimately mean significantly lower income. One thing we need to consider, but if we put that to one side, the other element, which was the large driver for the drop, is in relation to the ACA, which is the Affordable Care Act. Now, we have gone through this before, so if this is something you already know, you can move on. But effectively, it's government subsidized insurance markets for those, and probably quite a large portion of people, who don't in fact get any insurance for work. And the way this company makes money, in particular to this region, very similar to car insurance. So actually, they collect premiums from members, and this is, as we said, partially subsidized by the government. They pay the bills for those members, and more often than not, profit is made when they take more in premiums than when they pay in medical costs. Again, just think of it like we said, car insurance. Every single year, if you pay $1,000, if you don't in fact make a claim, that goes straight to the company. If you do make a claim and it's lower than $1,000, then ultimately the company does make money. If it's more, then they take a loss. So very similar in that respect. But there's also one added layer that we have to incorporate here called the risk adjustment, and this is to stop the company from picking young, healthy people, which in turn will mean less claims to be made, and avoiding those who are sick, which in turn will in fact increase the number of claims. This is called the risk adjustment, and the way it works here, if they end up with sicker patients, they get money from the government. If they end up with healthier patients, then they pay more money. So as we note here, to even the playing field. Now, this is the issue that lies where they did get data that 22 of the 29 states where the Affordable Care Act is in place, they've actually underestimated how sick their members are, or in fact, there were less healthy people who enrolled, and therefore what this means, they're now expecting to pay $1.8 billion in risk adjustment payments. This has also led them to withdrawing their 2025 guidance, which, as we've seen from other companies, we noted it in fact from United Health not that long ago, when a company does withdraw, not even cut the guidance, but withdraw, the market really doesn't like that, and you're guaranteed to see a double-digit drop. However, for this company, it was quite large, and as we said, impact is estimated $1.8 billion, which translates to $2.75 in adjusted earnings. Now, this is something we're going to incorporate in the valuation, so just remember, as we will reference this later on in the episode. And it probably doesn't help that we're also seeing now S&P Global Ratings looking to cut Centene to junk status. So there's a lot going on with this company. It doesn't seem to be getting much better in the shorter term. However, one saving grace that you could argue is that the market potentially has overreacted, and that is for the large part what analysts believe. As we said, doesn't get much better. We also have another insurer here, Molina Healthcare, lowering their 2025 guidance just days ago, and this obviously will also impact other companies in the sector. CNC though has been pretty much battered quite significantly, and probably why we didn't see something of substance this week. Now Molina Healthcare, another one now trading at its 52-week low, very similar double buy from Seeking Alpha and Wall Street, but one thing it doesn't have is the very strong factor gradings. Yes, A+ on valuation, but a D on growth and a B+ on profitability. So ultimately, this is an issue with their estimated earnings, and they're facing what we would call a double hit. You have healthier people dropping out of their insurance plans as the pandemic era benefits expire, and this has left them with a smaller and sicker customer base that's driving up their costs. At the same time, as mentioned, proposed Medicaid cuts from Trump's budget will slash their enrollments in their largest business segment, 75%, as we said, and therefore earnings is expected to take a hit. And we can see in just the next 2 quarters, they're anticipating large double-digit decreases, although this was an estimation given the fact they have now slashed their guidance completely. One positive aspect though to take a look is that over the last 4 quarters, they have outperformed analyst targets quite substantially as well, something we like to know. Now again, this is up in the air at the moment, and we'll also do a valuation that incorporates their updated EPS, but based on the expectation their forward P was going to be sitting in the 4 to 5 region, making it the lowest in the sector. Now moving on to some of the ratings where we have the growth, year-on-year revenue 7%, forward looking at 6%, pretty much in line with the sector median. However, we do know this is a company that has historically been growing their top line at a double-digit rate. EPS is projected to grow around 5% moving forwards, which is actually below both sector and their 5-year around the 10 to 11%, and profitability coming in at an A-. Now gross margin 14%, a lot lower than the sector at 60, a little bit below their 5-year at 17. Bottom line though, what does save them 2.3%, when the sector, typically as we've seen, burning through cash, negative 2%. Also an improvement bottom line than their 5-year average at 1.6%, and the cash they've generated from operations, 2.1 billion. Yes, it is a lot better than the sector, which is, as we said, burning through cash, negative 11 million, but quite a way lower than what they have done historically at 5 billion. All of these are things just to consider, especially when we get to our margin of safety. And it's also worth highlighting some of the underlying metrics behind the company. Consistent increases over the longer term, what we want to see from the free cash flow. We get quite a large drop into negative in 2024. Nice to note, on a trailing 12 month and moving forwards, expected to increase. And their sales growth, more often than not, has been at double digit. Last 2 years, back to back, 4%, pretty much increasing in line with inflation. Now, shares outstanding, as always, we love it when companies do those share buybacks, returning excess cash to investor pockets, especially when you consider this company doesn't pay a dividend. They have been diluting your position up until 2021. Since then, though, they've been doing the opposite, buying back shares, and we would like to think management will take this opportunity, if there is cash lying around, to start buying back shares, given how much the share price has been hammered. ROIC, we want around 10% just to give us faith management are able to effectively allocate their capital. We're seeing there or thereabouts year on year, so no real complaints. And their margins, we've already had a look. Yes, it is lower than what we want, but pretty much around what we've seen in terms of comparing it to the sector. Bottom line though, as we highlighted, net income a lot better, and free cash flow ideally to straddle around 5%, something we see from time to time. Big drop, however, on a trailing 12 month to the 1% point. Finally, the net debt to EBITDA, number of years it would take them to pay off all of their debt net of cash on hand, correlates to balance sheet strength, 0.21, very low on a trailing 12 month, 0.48, so a jump expected, but still fairly healthy, so the balance sheet, no worries, no red flag indicators is what we would say for the time being. But we also want to highlight their performance against others in the sector. We have Molina Health, Humana, some other very well-known names. Remember, the whole point here is to identify, is this an issue isolated to the company or in fact widespread across the whole industry? And we can see pretty much the majority of companies are in fact down in the 12-month period. CNC, the worst performing though, around 51, and over the last 5 years they're still down around 50%. In fact, the industry hasn't been the best either over the last 5, and over the last 10 years they're still down. In fact, one of the few that's been negative during this period. So ultimately, it hasn't been the best healthcare pick. Likewise, and you probably know the answer, it should be clear and obvious, against the S&P, they've massively underperformed in the last year, negative 51 versus positive 12. And then when we look, in fact, on the 5-year basis, again, negative 50, positive 96. And as we highlighted at the beginning of the episode, even over a 10-year stretch, you would still be down from your initial investment, negative 13, versus the S&P's 193. Now, 2 more things before we jump into our valuation. First one, let's look at the income statement. We can see their revenue pretty consistently increasing over the period, quite rapidly too, 22 billion 10 years ago, now sitting at 148 billion. But the main thing we want to identify here is, what does the bottom line tell us? Is it this same consistency in line with the revenue? And for the large part it is. We do see a few bumps along the way, but their bottom line has gone from 355 million, nearly 10x over the last 10, to 3.3 billion. We then move to their balance sheet, a quick health check, total cash versus total debt, where cash has been increasing, 2 billion 10 years ago, now sitting at 15. But remember, in isolation, any number here will give nothing away, so we compare it to their total debt numerically and directionally, which has also gone up. We're talking 1 billion 10 years ago, now sitting at 18. So total debt is a little bit higher than what we saw for the cash, and that is why net debt to EBITDA sits just below 1. Overall, balance sheet does look okay, but as we would say, something to keep an eye on a quarterly or yearly basis. Now, just before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy of severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then jump into our valuation, which gets to $73. Now, we have just used the DCF model, but we also want to walk you through the other models so you can understand, if you're interested, what the values would be. Now, first one is Graham's valuation, and if we were to use the initial earnings per share, we can see we would get an intrinsic price at $49, which is currently above the market price, so an undervaluation. That is based on the current AAA corporate yield and the long-term growth rate. Now remember, they did in fact say that they were expecting to lower EPS by $2.75, and a quick calculation would mean that this updated number would come to $1.78. And if we were to put $1.78 into the equation here, we can in fact see that would come down considerably lower, giving an overvalued signal. We then move on to the multiples valuation model, where we have got companies in a similar sector and size that we did just run through. We then get their average P. Now this is based on the EPS at the lower end, coming to an overvaluation signal with an intrinsic price of $21. Now they currently don't offer a dividend, so this model for now is a little bit useless. But then we move on to the DCF model, which we do believe the most appropriate today. Now there's a few things that we do want to let you know before we jump straight into the value. First one, average growth over the last 10 years, 66%, although we can see in 2024, as we highlighted earlier, it was in fact negative. So what we have done for 2025's starting position, you can see we've used 1380, which is the Q1 free cash flow generated. Now we've extrapolated, so we've times it by 4, and then to be conservative, we've cut that in half, divided by 2. So extrapolated for the full year, divided by 2, so we can be conservative. And then to go one step further, moving forwards with the growth rate, we've got -4 at the lower end. That means decreasing year on year. The same on the medium, but to a smaller extent, -2, and high, keeping it flat at 0%. Now, first thing you might be drawn to is that no matter which option you use, as we will come to show you for transparency, we're talking over a 100% upside. In fact, at 0%, if they don't increase their free cash flow anymore, we're talking a nearly 3x. So we have here, for being conservative, the lower end at -4, with the discount rate, the present value of future free cash flow and terminal price add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, $73, indicating 125% upside. -2, again transparency, $82, 152, and for those that believe it should be flat, because we have been very conservative here, $93, 186. Now remember, these numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for CNC or any others, but we're going to take through the low end. Again, just want to be very conservative at -4, and we're not done there because we always apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $66, then we keep going till it's near the current trading price, and what you can ultimately see for CNC is that you're getting at least 50% up to $37. 55 is where we see this right now, and on average, if we accumulate all of Wall Street's and their price target, it sits at $65, which is pretty much bang on 100% upside, and that is into 2026. Now, these are just estimations, MOS 55%, but give us your thoughts on CNC. Is this one worth considering? Do you like the industry as a whole? We've covered UNH, we've covered many others, so do give us your thoughts, or perhaps you think there are other industries that do look severely undervalued. For CNC, in your opinion, buy, hold, or avoid. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.